Let's talk property now, because the IPD South Africa Annual Property Index, which shows the South African investment property sector, delivered an ungeared total return of 12.9%, very respectable, in 2014, but that is down from 15.9% in 2013. And in the studio now, Vice President of MSCI, and that's Phil Barttram. The property sector, we've been doing a lot on property recently on Power Lunch, and indeed other shows on CNBC Africa. It's come across that it's been an asset class that has consistently outperformed, and yet has been more or less overlooked up until the last couple of years by the big fund managers.
Well, we tend to, the index that we create looks at the underlying property. It doesn't look at the listed sector itself. So we have both listed and unlisted funds that give us their information. We create an index on the back of that.
Yeah. So
when you say it's been overlooked, I think it does have a big part in very many of the big asset owner portfolios. They do have direct property in there. So I would say that it's taking a much bigger place now in asset allocation decisions.
Yes, indeed. Why the drop from 2013 to 2014?
Essentially a decline in the capital growth that's been attributed to the underlying assets. The capital growth is a component of both the rental growth that you get plus a valuer sentiment, if you want to call it that. And valuers are now starting to take a little bit of the price off the top of the underlying assets. Is
that a trend that will continue in 2015? Have you seen? I mean, we're nearly at the end of the first quarter now.
We'll have to see what happens with with growth through the country. So if there's enough demand, we may well see the valuers giving some of that capital growth back. The rental growth looks fairly stable. So across the entire 265 billion rand of underlying property that we have in our index, we had rental growth of just shy of 6%, 6.5%.
So keeping in line with inflation?
The base rentals are keeping in line with inflation. The property owners are getting a lot cleverer in the way they manage their income, so they are getting more income into their portfolios. Net income on the portfolio at an underlying property level was growing at around 8%. So base rentals at 6%, but they're getting additional income from other sources, which is making them grow their net income at 8%, which is good.
Yeah, you've got 265 billion, you say, within your index. What are the trends within that index, whether it be different types of property, different geographical nodes? What's been emerging in the last year?
Well, what was interesting for us is the spread of return between the different segments of property. So we have 14 segments. So within retail, for example, you could be investing in super regionals, or you could be investing in neighborhood shopping centers as an example. So you'd have a size element there.
Yes.
And what we saw this year was that the smaller retail centers actually outperformed the big retail centers. Now that would be counterintuitive. A lot of people tend to believe that the super regionals or the regional shopping centers would be outperforming the smaller ones in this market. And what's happened is that hasn't been the case. We also saw one of the sterling performers last year, being the light manufacturing sector, pulled back quite substantially. So that's also been outperformed by some of the other industrial sectors that we look at.
Let's go back to the retail centres, because a trend was put in place by companies like Woolworths, for example, where they would have little shops here and there, and then they started buying up those. They were franchised, and they started buying those up and going back to the bigger stores. But you're saying the opposite is the case when it comes to the actual shopping centres themselves.
Well, the shopping centres, the investment in the shopping centres themselves, the return, the total return you get from there, which is a component of both the income return and the capital growth, this year surprisingly had lower total returns in the larger dominant sort of segments, which is surprising because it's tended to be recognised as a more defensive sector within retail.
Yes.
So if you were looking to get a defensive investment, you would invest in super regionals, and given there's all this uncertainty around the economy, we would have expected that to perform better than the smaller neighbourhood and community type shopping centres.
Yes, indeed. I suppose that if you're not quite confident enough about the South African economy, which is only forecast to grow 2% in 2015, you're going to say to yourself, well, you know, if I have to develop a shopping centre, make it a smaller one and test the water. Of course, it doesn't work like that, but I suppose psychologically, confidence is a big factor here.
Well, the development isn't really an issue in our index to too much of an extent. We have an existing portfolio, so it's all the guys that hold their property for a long time.
Yeah.
And the big super regionals there would be defensive just because they've got so many tenants within their base. One drops out, it doesn't make a huge impact. In a neighbourhood shopping centre, you lose your big tenant and you've got a big open gap in your income stream. So that's why they're seen as defensive. But what we've seen this year that's been quite interesting is that we think the market, or the valuers particularly, are pricing, I think those assets are already fully priced, and they're starting to take a little bit of that price off the table, particularly in the big ones.
When you say that the rentals are more or less keeping up with inflation, what about vacancies?
Vacancies are stable. In some instances, we've even seen good improvements. So once again, the owners of property and the investors in property are playing a good game here.
Typical South African. I'm talking about shopping and talking about retail because we're a nation of shoppers, whereas of course we should be talking about the industrial side of things. You mentioned light industry. Tell us more.
Well, the light manufacturing sector was sort of a poorer cousin, if you wanted to call it that. It was tended to be ignored by a lot of the big investors. And as you know, as you've already mentioned, most of their portfolios are heavy in retail. And over the last year, or 2013, what we saw was that a couple of the guys did start recognizing a shortage in supply within the light manufacturing sector specifically. And they started seeing the pricing power that was coming out in the rentals, and then subsequently started investing. What we're seeing this year is that once again, the market is sort of sensing that that particular sector may be well priced now. And they're not giving all the rental growth that's really strong in that sector through in the capital values.
What about larger manufacturing? We're talking about light industry now, and that suggests that, you know, small and medium businesses are thriving, which is of course exactly what South Africa needs. But what about the bigger boys?
Well, the light manufacturing sector for us is actually established industrial sector, so it is the larger sites, or the larger assets. We have another segment called workshops, standard units, and that has outperformed the light manufacturing. So, but that's a very volatile. It tends to be seen as a far more risky sector. But the big guys seem to be doing okay.
14. You've got 14 different segments. You've mentioned a few of them. Give us some of the highlights and lowlights of the others.
Well, I think the key point is the base rental growth. So we're seeing, which is the underlying component of any property. You want to know that your rentals are growing. And what we're seeing across the market is that is stable. What we've seen, though, is that the base rental growth in the larger retail centres and the light manufacturing is very strong. It's up to 8%. So that's the big highlight, is to see that is still strong and stable. Also, that we haven't seen vacancies increasing substantially in any one segment is a really positive sign. I think on the negative side, what we are seeing is that prices, capital values, are fairly well done now, and we're starting to see valuers look to the secondary assets or the less quality assets to say, okay, maybe there's some price movement we can have in this next. So that's what we're seeing. It's quite
a dichotomy, isn't it, between property? I mean, we always bring this up. You know, retail is doing well, and the retailers listed on the JSE are doing well, and yet everyone's so beleaguered and downtrodden in South Africa, and we've got no economic growth, and we've got this problem and that problem. But they keep on churning out good results. So do the banks, and it seems that the property sector does as well.
Well, it's a hybrid asset between equity and bonds, in effect, because you've got a consistent income return over the last 15 or 20 years that we've been creating this index of between 8 and 9%, which is substantial. Then you throw the capital growth on top of that, and you're getting a really good, solid, stable return. So property will do well. Remember, we're only looking at the institutionally invested stuff, not the institutionally, but professionally invested real estate. So it's professionally managed. It's really well run. The guys are clever in the way they allocate their money. And
are we up there with our international peers, by the way, mentioning how well we run it?
We're, in my opinion, we're actually better, particularly on an income yield basis or income return basis. We're better than most countries.
Good, Phil. Thanks very much for popping in this lunchtime. That's Phil Barttram, Vice President of MSCI.